Hi, John Dobis from Forbes here with Suze Smith from Strategic Portfolio Solutions. That sounds very sophisticated, but to break it down, you are an options seller, right?
That's correct. I sell premium for a living, collect it in for the clients, put it in the bank, use those profits to buy high quality dividend stocks, which in turn I sell cover calls on.
Woman after my own heart. I spend most of my days doing those kinds of trades as well. So let's, you do about 80% spread trades, right?
Correct.
So let's back up a little bit and just talk about the simpler types of option selling, put rights and buy rights. A put right is what?
A put right is where you sell a put and they will take margin for whatever strike you sell it at. So say you're selling an IBM 100, they're going to
100 shares,
100
times
shares
100.
times 100, and that's what's going to be withdrawn for a certain amount of credit. The important thing when you're doing that is you want to ensure that you're getting enough of a percentage credit to make it worthwhile tying up that margin.
Right, because even if you don't buy the stock, just to have that margin set aside diminishes your buying power.
That's correct.
And it's pretty
That's
similar situation, right?
opportunity
When you're doing buy rights. So a buy right, you buy the stock, sell an out of the money call. And
correct. I just did yesterday a cover call on STX where I bought the stock. I sold the October 35s because I don't like to hold anything over earnings. Earnings is there's no
big
edge
surprises come out of it.
in
Nothing
holding
good can
over
happen.
earnings. So it hopefully will call at 35 before earnings. Other than that, I'll just go ahead and close it down. It's in profit.
And those kinds of trades, you're not looking to be home run hitters. You're looking to hit a good single or double, like maybe 2% a month, 1.5% a month. Annualize that out. That's 18 to 24% a year, which is like double or more what large caps have done annually since 1926.
Correct.
Makes it sound great, right?
Correct.
But you're tying up that capital. So
Correct.
hence, here we are now. So spread trades require less capital because you're not on the hook to buy the stock. Explain what you're on the hook for and the mechanics of credit spread trades.
Well, with credit spread trades, you are on the hook for something.
True.
You need to go into a credit spread trade, whether it be selling a bull put spread, which is where you sell a higher put and buy a lower put, or a bear call where you do the reverse and you buy the lower and sell the higher.
Right.
Okay. You're at have a responsibility if it breaches that you could be assigned the stock. Now, the flip side of that is you can use stops, you can use deltas. I use 90 deltas, so whenever I go into a trade, I'm at least at a 90 delta, so I have a 90% probability of that trade going in my favor before I even enter it.
Okay.
For something like that, I generally run 10 to 20 point spreads. On a 10-point spread, I generally try and collect somewhere $1, $1.50, because I'm way out of the money.
All right.
If you look at a chart with Bollinger Bands and a 200-day moving average, I'm under the 200-day. I'm looking for that support there.
The advantage of that is it's less likely that you'll be assigned and called upon to do something, either produce the stock or sell the stock.
Correct.
Which you may not even have. But the flip side of that is
ties up.
you get less credit up front. If it's
right.
closer to the current market price of the stock, you get more premium, but there's a bigger chance that you may have
and
to.
I've seen a lot of people blow out their accounts by doing risk one to make one. I would rather take less money for less risk, know ahead of time what I'm going to more than likely be able to get, and close it down early when the stock moves in my favor.
I like that. So what kinds of stocks do you choose as underlying stocks when you're, let's say, a bull put spread, so you're bullish on the stock? I mean, are there indicators like MACD or RSI or whatever, moving average, crossovers? What to you says this is a bullish chart?
On my charts, I start my chart reading at the bottom where I have the full stochastic. My favorite entry is when it comes down and crosses up, the black line crosses the red from an oversold position. That's an almost no-fail setup on that. Next up is my MACD. You'll see the histogram start to stair step up well before you actually get the MACD cross.
Right.
So that's another
So the
indication
longer term
of,
will be curling up.
so it'll be curling up, or the histogram will be stair-stepping up, and you'll see the MACD lines actually starting to turn. So all
Gotcha.
of this is happening as I'm putting on my trade while we're still at the bottom, because the stochastic, it represents the rate of change of money flowing into that stock. So it's a little more current information than what you're getting on a longer term time frame. Of course, you want to see a nice clear candle, coming off of a bottom,
Right.
or something, vice versa, coming down off of 80 oversold and crossing down, which would give you a sell signal.
So you're pretty. You like to operate far out of the money.
Well out of
but-
the money.
So I guess maybe you don't have to get out of positions frequently, or if you do, what would cause you to exit to close out a position early?
As of, for instance, 2 weeks ago, I put on an IBB 310 over 290 bull put spread. The IBB is trading somewhere in the 340s right now. The option went down to 20 cents. The meat is off the bone. Exit the trade, use the margin, go find another trade that's going to pay you again. Rinse and repeat.
That's it.
Keep
I love
using
it.
that money. Keep using that money.
I'm a convert. She's preaching to this choir right here. But you have a website?
It's www.investsps.com.
InvestSPS.com. Good talking to you, Suze.
Good talking to you.